I've done a lot of work with daily charts and showing you how I look for springs and how I draw lines on charts and look for ending action, reading price bars individually. Most of the work has been centered around daily charts. We did look at a few weekly charts on Wednesday and so on. Now, I wear another hat, and I guess it's a vestige of my relationship with my mentor, the man who in 1971 was trading for long-term capital gains, and he was looking at the mega trends. He was interested in the mega trends. He realized in 1968, 1970, that there was a good chance that the commodity market was poised to go up. This is a cash cocoa yearly chart. This chart goes back to 1930. Commodities in general peaked in the late 40s, 47, 48. Some of them made slight new highs in the early 50s in trading ranges. Does anyone know what caused the highs of the late 40s, 1940s? Post-war, the Marshall Plan, rebuilding and refeeding the world. And it led to this sharp rise in commodity prices. This is World War II. The exchanges were shut down, and this is not futures, but cocoa trading, I guess, was fixed. A lot of commodity prices were fixed. But after the war, we had this explosion. It looks like cocoa peaked about 47. And you'll see on commodity charts, I consider it to be plateaus. Plateaus are levels of long-term nature where high prices curtail demand and low prices curtail supply. It just took something else to shift that into a whole new plateau of prices, which occurred, of course, starting in the early 70s. In the case of cocoa, it peaked in 1977. Cocoa is one of those inelastic commodities, that is, inelastic supply-demand relationship. It takes a great deal of money and time to grow cocoa trees that will produce cocoa beans. You can't do that in 6 or 9 months. Therefore, if you have a shortage of supply, the price will go up quite nicely for a couple of years or maybe even longer before enough trees are coming on to produce enough to stop the advance. Conversely, when the price of cocoa has gone so high that the whole world that can produce cocoa is producing cocoa, it's going to take a long time to drive them out of business. And that's what happened between 1977 and 2000. There were intermittent rallies, but still the trend was down. This is a semi-log chart. In other words, we're showing percentages here. We're showing the actual price, but you're seeing percent of movement. So the greatest percent of movement occurred here in the 1940s, but we probably moved more in 1977. That's about a $2,500 range than we did from 1930 to 1973 or so. I analyze the price bars or draw the lines just as I would on a daily chart. Here's a line of resistance, initial resistance. The market comes up, it upthrusts it. You see the position of a yearly close right here. The market comes down, it washes out this level of support. It comes back on top of this previous level of resistance. And it comes up here again and backs off, and now we've jumped above it. Cocoa made a low in 1992, tried to rally for a few years, and then had one last decline, which was in the year 2000. The range in the year 2000, you know, of the semi-log scale, as prices decline, the bars will get wider. And yet the range in the year 2000 was probably the second narrowest price range of any since the high. It's amazing that we went under $1,000 a ton and we had such a narrow range. It was a very weak year, but it was not accelerating. It's just steady weakness and erosion. Another thing that I like to do with long-term charts, and I'm no statistician or a great mathematician that works with cycles from that point of view, but I've always been very fascinated with cycles. It's helped me determine when a market is in an area of time, as someone wrote, a window in time, when there may be an opportunity developing. And somehow or another, I've been pretty good on a long-term basis since I've been doing futures since 1971 at finding major extremities in time. In fact, I think it was in 1999 or the year 2000 that I wrote an article for Futures magazine dealing with the Comparative wave. How many of you have heard of Comparative? Well, he was a Russian economist, and he developed, or he discovered, this long wave, this long economic wave, somewhere between 55 or 54 and 60 years. What?
54 years.
Yeah, 54 and some say 60. In any event, there is a range there. And he has shown this not only in commodity prices, but in interest rates, in stock prices, and so on. So I've always been fascinated with this subject. If you're going to trade with a 54-year cycle, my one prerequisite is to use a close stop. That's mandatory. I look across this chart and nothing sophisticated. My method of finding cycles is just to take a low, like 1933, I guess, and going across, here's 1940, so that's 7 years, and just making an average. I mean, this cycle from here to here is 9 to 8 to 8 to 10. It averages out at 8.43 years, and I say plus or minus 1.5 years. So trading with a plus or minus 1.5 year window is still a bit risky. But it says that cocoa is supposed to be making a low sometime this year, or maybe late this year, or maybe early next year. I'm very interested because I view the decline in 2000 as a spring of the 1992 low. This is the response to the spring, and the market is pulling back and testing. If you look in the book Entries and Exits, in the section where I was interviewed, I think Alex included a yearly sugar chart with a 17.5-year cycle, if I remember correctly. The 17.5-year cycle is present in lots of phenomena. The stock market, for one, maybe the lake levels at Lake Erie, all kinds of natural phenomena. In this 1999 or 2000 year article that I wrote for Futures, I showed a chart of wheat prices from England spliced to the U.S. going back to like the 15th century. And it shows the Comparative wave very nicely. So this is what I'm doing with long-term charts that makes me interested in areas, what I call areas of focus. For the year 2007, my areas of focus in terms of long-term trades: cocoa, cotton, and soybean meal. If anyone is interested in long-term charts like this, there is a company that provides them. It's called the chartstore.com. Certainly he has commodity charts, not all of them. He doesn't have meal and soybean oil. But he has corn, and he has cocoa and sugar and coffee and cotton going back to years like 1930, and some even earlier than that. And he has charts also adjusted, CPI and PPI adjusted, just like you were suggesting. It's quite good, and it saves a lot of work. And those monthly charts are updated once a month. The data is included. It's a great service and it's very inexpensive. All right, well, let's take a look at the next one. In soybeans, there's roughly a 5.5-year cycle. I said here average 5.5-year cycle, plus or minus 12 months. You see the springs on this chart right here in 1938. You went underneath this low of a few years earlier and held, tested, and then off we went. Over here in 1960, you washed out this low of about 1950 and had a rally. And we had this explosion. In the year 1999, which was the bottom of the big decline in commodities, as you can see, we washed out the low of 1975 or whatever this was, putting it in a spring position. Just looking at this, just looking at a monthly chart of all of this, without even the yearly, would have shown you what a potential extremity it was in soybeans. And then, of course, it held in here for a few years, and then we took off. I tend to believe all of this is testing this spring, and that prices will return to the top of this trading range. That's not predicting inflation. I'm just saying this commodity has the potential for whatever reasons may unfold. The corn cycle is pretty much the same as it is in soybeans. It's around 5.5 years, average. The other area of interest for me this year is cash cotton. This was the 1986 low. We took this out in 2001. This is the average 17.5-year cycle that I mentioned that exists in sugar, that exists in the stock market. It's also present in cotton. That doesn't mean that they all bottom on the same years, but the cycle exists in each of those markets. Again, I'm just using the cycles to try to find a point in time where it becomes interesting to start watching these commodities. So cocoa, soybeans, and now cotton. Of course, you see the big upthrust here in cotton when we went to all-time highs above the high that was made during the Civil War. The record high, over $1. You know, William Faulkner his brother wrote a book called Dollar Cotton. Well, there it was. Well, I just wanted to show you that dimension of what I'm doing. I enjoy updating these charts and staying in touch with the big picture. And I think it doesn't hurt, of course, to look at monthly stock charts or futures charts to see where we are. And maybe you can even find some cycles. Something else I want to show, the spread. There are different types of spreads. You can put on a spread between March corn and May corn. That is, buy March corn, sell May corn. Or you could put on a spread between March corn and March wheat. A spread between two different commodities is called an intermarket spread. Spreads between two contract months of the same commodity is intramarket. This is a high-risk intermarket spread which got killed today. But I'm interested in what's going on. Let's go to the other chart first. This is a weekly chart using continuation data. In the year 2000, NASDAQ futures were over 3,000 points premium the S&P futures, because we had such an incredible blow-off in NASDAQ futures. By 2002, they were almost par. In other words, the spread was plus 10, premium the NASDAQ. So, if you had bought the S&P futures in 2000 and sold the NASDAQ, although they both fell, the NASDAQ fell so much more that you would have made this kind of a huge profit on the spread. Spread margins are typically much less than the initial margin on an outright long or short position. But when you're doing an intermarket spread, and particularly one that's this volatile, it will be more money. But to do the NASDAQ S&P E-mini trade, 5 E-mini NASDAQ is around let's say $15,000 worth of initial margin. And you would do 2 S&P E-mini, and that would be about $8,000. So we're roughly talking about $25,000 is what the initial margin would be to do all of those contracts. The spread margin is around $2,700. So if you do one spread, that is if you go long 5 NASDAQ and short 2 S&P E-mini, it'll be $100 a point in the spread. So over here in August of this year, the spread was around 240 and it went to 400. That's 160 points times $100. NASDAQ was much stronger than the S&P between August and November. This is the trading range in the spread. You see the Dow Jones has gone above its 2,000 high. The NYSE has gone above its 2,000 high. The Russell 2000. The S&P is not that far from its 2,000 high. NASDAQ, this is NASDAQ 100, not NASDAQ Composite. But NASDAQ 100, it made a new high since 2002, just last week. But the spread, since they've both gone up, has been in this trading range. I'm considering a position in this spread, thinking that this spread is probably about 375 points premium to NASDAQ. I think it might go to 500 or 600. If they both can continue to go up, I have a feeling that NASDAQ would outstrip the S&P. As I looked at cotton and cocoa and soybeans from a cycle point of view for possible long-term trades this year, I'm just sort of keeping an eye to see if NASDAQ can indeed hold its gains and assert itself against the S&P this year. So far, that's not really, it started out, but now it's turned down pretty sharply here today with Apple's big break in the stock market. Well, anyway, any other questions about this?
That ratio that you have, the NASDAQ and S&P, number of contracts, that stays the same?
You understand that the NASDAQ trades at $20 a point, and the S&P trades at $50 a point. So you can't do one for one. So the way you can get it so they're both equal is to do 5 NASDAQs times 20 is $100, and 2 S&P times $50 is $100. That way they move exactly together. You follow? That's why I'm doing 5 and 2. So if you want to do 5 spreads, you've got to do 25 and 10. You have to do 25 NASDAQ and 10 S&P E-mini. And that would be 5 times $2,500 margin. So it'd be $12,500 margin. If you do 3 spreads for roughly $7,500, that's almost the same as doing one big S&P. One big S&P moves at $250 a point. But you know what the margin is on that one big spread? That one big S&P? It's $20,000. I can do 3s for $9,000 and get $300 a point. So that's leverage. Works both ways. All right, I've certainly enjoyed talking with you all about all of this.
What we would like to do is this. For the last 4 days, I have been showing you my approach to trading. David has been showing you his approach to trading. I'm sure if you were paying attention, you noticed that there are important similarities between how we approach the markets. And there are also important differences. What does it mean? Does it mean that one man knows what he is talking about and the other does not? Or does it mean that we're washing a very large elephant and we're sort of describing we're specializing in various body parts that shall remain nameless. And so what we would like to do now is give you an opportunity to watch us reviewing the same markets. So I suggest that you call out a market or a commodity or even an individual stock, and we will take turns. First, one of us will tell you one man analyzes the market and the other man will do it. And you will see sort of to bring the differences in sharp relief. What we want to help you do is to have a binocular vision. Yes?
D is in dog, E is in Edward.
Deere,
Yeah.
John Deere.
This dog been around. I guess it's my template. So we go back now 12 years, right? And looking at this chart, I can say that relative to its own history, John Deere is expensive. It was cheap in the 90s, had a bull market, another long trading range, and at the right edge of the chart, it's trading near the end, near the highest price it ever had. It just actually crossed an important psychological boundary by being $100.16. Prices are connected to value with a rubber band, and that rubber band is very, very overextended. Okay, if you can please interrogate this bar, this tall green bar. The high here was 101.40. What's the high of the current bar? It's 100.95, so we're just about getting there. I can tell you that I would be looking to sell this thing short when it stops being green, right? At this point, the impulse system allows me to get long and long only, and I have zero desire to get long something as toppy as this pattern while force index is tracing a bearish diversions. I'm not even going to ask to look at the daily chart because the weekly prohibits me from shorting, and that's the only thing I would want to do here. Over to you, David.
On the weekly, I would just have a horizontal line drawn across this high back in earlier 06, huh? And the market pushed through that high, has been sitting here, and if you draw a line underneath this first week, after this week, you pull back, you move lateral 2 weeks ago or 3 weeks ago, whatever it is before that week, you went into a spring position and now you moved up. From my point of view, it could still be that this is absorption, but we are in a difficult spot right here. And it's certainly not a place where I'd want to be buying it. If I'd been interested in buying it, it would have been on the little spring of this low here on the weekly chart when it started to come back up. Right here and now, it doesn't interest me. Let me just see the daily real quick. I wouldn't want to be a buyer here, but right here and now, I don't see anything that's terribly bearish for the near term. We are testing this important high. We'll see if we can get through it or not. But for me, the breakdown point, or where it really gets iffy, would be coming back underneath this day's low and erasing this ease of upward movement here. Here you can see the spring that I was referring to if you drew that line right there. That's all right. I'm going to go to another one now.
GRL?
Toll Brothers.
Why don't you go first, David?
All right, let's start with the weekly. We have an uptrend line off this low and this low. We've sort of held it so far. Market took out the low of this week here and reversed upward. I know that this sector of the market is very much under favor right now. That's why we declined to last year's low. I think it still looks as if it's trying to consolidate and hold. We definitely had some huge climactic volume right here on the weekly chart. There's nothing immediate about it. Let me just quickly see the daily chart. Now, you see the spring action. You draw a line under this low, how the market went underneath it, bobbed back up right here. We've had this rally, we had this nice test. These last 2 days don't look too delicious. Giving this downtrend line here. The poor closes on the last 2 days. There's nothing that makes me want to buy it at this time, but I don't think it looks overtly bearish or anything like that. Okay, Alex.
If I could see the weekly chart, please. The stock was a cheap, under $10 stock. Then it ran up to, what, about $60. Went down to 20. It's now at 32. So it's right smack in the middle of the range. After listening to David for all these years, I'm looking for my trades at the edges of the lake, not in the middle. This thing is right smack in the middle of the lake. Let's blow it up a little. So, yeah, like this. I would have to say that the trend is up. We had an important low in summer. We have a higher high, higher low, higher high, higher low again. If somebody held a gun to my head, I would be buying this thing, but man, I don't want to be buying this chart. Let's take a look at the daily for a second. On the daily chart, look at the power of bulls here. And then 3 attempts to rally. 1, 2, 3. Bulls, bulls, and bulls, right? So this is like a missing right shoulder type of thing. So this rally that has been going on is not having too much luck. But if we go back to the weekly chart again, I'm not really that interested in selling it short. To sell short, I would rather be watching a stock like we just saw, Deere, which is expensive. This thing already took it on the chin, lost 2/3 of its value. So it's, I feel if I squint long enough, I'll give you a trade, but I would much rather turn the page.
One interesting line on this chart I see is to draw a horizontal across that low. Yeah, you see how we held this level of support, went under it, tried to rally through it, now we've come back up to it. So you can understand the hesitancy here. All right, well, let's see something else.
Something more exciting.
SPY?
SPY. Long bull market, distribution pattern in the late 90s, 2000. Severe distribution pattern in late 90s, 2000. Severe bear market ending in a multiple bearish diversions, putting a bottom under 2003. And now S&P is pushing towards its all bull market highs. Meanwhile, the Dow has already made a high. So this market is, in terms of its own history, expensive. David spoke a minute ago about cycles. I'm certainly no great cycles expert, but there is a certain rhyme, certain rhythm to this whole thing. And you can see that S&P is like, there is a bull market situation, no question about it. The chart is moving from the lower left to the upper right corner. This is a bull market. But it inhales and exhales. It exhales at the end of 2004. It exhales again in 2005. In spring, it exhales here. It exhales here. And now it's been inhaling for a good long time. It's way overdue for a... At the right end of the chart, I see a very attractive pattern for what I think is an upcoming exhalation. I use the impulse system, and green means you're only allowed to buy. When it stops being green, it gives me a permission to sell short as well as buy. It stopped being green as of this week. My favorite kind of a trading signal is not the color, but the loss of color. When the chart stops being red is when I want to buy. When the chart stops being green is when I want to sell short. So this weekly chart really sets me up. I want to be short this market. MACD histogram is not very helpful. MACD lines show that this really topping action, you can see this action happened in the past every time leading to market exhaling. Force index is showing certain raggedness at the right edge. I'm looking for this market to exhale. Am I waiting for a crash? No, I don't know. This chart doesn't give me enough information. If SPYs were to go from, let's say, the current level of 142 somewhere into 130 range, they could do that without violating even the structure of the bull market. So count me as a bear. And if just for a moment I can take a look at the daily chart, there is this line. We had a false upside breakout, which began last Friday. This was a little breakout to the upside at the right edge of the chart. The daily chart, as of today, stopped being green. So we got the permission to sell it today. The daily MACD lines look just awful. Force index is non-contributory. So count me as a bear, and looking at this chart, if I wasn't already short, I would go and sell it short at the opening tomorrow. I said my piece.
All right. Let's leave that one out. Alex has certainly pinpointed the critical piece of information here. Here we have a high. The market pulls back very grudgingly in here. Comes back up. Great ease of upward movement for 3 days. And the last 2 days, what happens when a market has narrow price range when it goes through a high? No ease of upward movement and closing well off the highs. That's not very good. Looks very tired. I'd say it's certainly vulnerable on the near term. Go back to the weekly for just a second. What I notice is that we've had an incredible rise since July. I think a 10% drawdown is way overdue.
And I would just like to reinforce what David said. It's overdue in terms of time. We're not speaking just about the time, but also about technical indicators of raggedness.
Right.
So it's both overdue and the technical signals that point to the raggedness.
What's next? Go right ahead.
SUNW, Sun, Microsoft.
All right. You want me to start? What's the first line that I see? First line I see is drawing this line right here. All right. The story is the market came up to this area, churned up and down, absorbed, had this great ease of upward movement here, very big volume. Now, when a market goes above a high, turns around and continues and comes back, or either testing the breakout before going higher, or this is going to be an upthrust. Now look at the evidence of the daily chart. I don't like this day. You notice since July, we have not seen a day with this wide a price spread between the high and the low. It is also associated with, I think, the heaviest volume since the July low. Those two factors taken together suggest to me climactic action. This is too much. I'm concerned about that action. We have not broken down yet. Let's see. I guess if we start getting back down under this level here, we're in trouble. But I'm very suspicious of when I see this whooping up a price and this much volume. It tells me the public is really jumping aboard and to beware. Can we see a monthly on this chart? So what we've done is we've gone back and upthrusted this whole affair, this whole trading range here. We drew that line originally off of this point, but it actually goes back into 03. A lot of people have bought and bought and bought and bought, and again they've bought. And it looks like right over here is where we accelerated down. So this is a very important level in this stock with this climactic action that suggests we're going to try to pull back again near term.
Sun Microsystems. From what little I know about fundamentals, this is a very important electronics company. It's not a fly-by-night thing. They have a place in the economy and they're not likely to disappear. Having said that, I want to mention that the company went to $60+ and it's even now, many years into this bull market, is trading at less than 10% of its peak price. So this is a fallen angel. Right? I love fallen angels, I like trading fallen angels. So when I look at this thing, my first curiosity about this place is, where do I buy it? It's a fallen angel. By definition, I have zero interest in shorting this stock. But where do I buy it? If we blow it up a little bit more. Clearly, as David pointed out, it comes up to this 5 and change line. And it has failed 1, 2, 3 times. And it's acting in a questionable manner that we're going to look at more closely at this line. But I'm not a breakout trader. So the question I'm going to ask myself, should I be going in and nibbling on Sun here? Or do I think there is another decline coming up that will give me an opportunity to buy it? So let's take a look at the weekly template. We know that there is a line that across this high. As of this week, last week we were only allowed to buy Sun or stand aside, but not sell it short. Suddenly we have a permission to sell short here. The action this week is not friendly, not nice towards the bulls. At the same time, the rubber band is way overextended to the upside. The indicators are sort of nothing special. MACD lines are starting to turn, I think. MACD histogram is getting a little ragged, but there's no great divergence in MACD histogram. Force index just showed this very nice rally. So there is nothing terrible about this chart, except there is very little attractive because it's so high. And what I would be inclined to do, if we can go back to David's monthly template, what I would be inclined to do is, if I had interest in trading Sun as a fallen angel, I would go into my E-Trade account and put an order to buy 100 shares at $4.02. If they don't like round numbers, Kerry suggests 398, 398 or 402. But you see what I mean? I mean, this puppy is not dying. But I think this puppy just inhaled a little more air than he could handle. So he wants to just exhale, lie down. But for someone who is a long-term position holder, which I am teaching myself to do, somewhere at $4, I want to buy it. And as I said before, instead of just putting an alarm on the computer screen, that alarm is going to ring and I'm going to be in a different place. I'll ignore that alarm. I want to actually put an order there. So I would put an order to buy a Chihuahua size order, 100 shares, but I want to get that fill, and then I have to decide, what do I do next? Do I keep it and add another 9,900 shares to it, or do I bang it out? So count me as a buyer at about $4.
Please, Alex, if you're a buyer at $4, why wouldn't you short at 530?
I wouldn't short at 530 because I think basically it's in the value zone. It's in an accumulation zone. I want to short. I want to get in again, to use wonderful example that David used. I want to fish the edges of the lake, and I think this stock is very much at the edge of the lake, and it's at the south edge of the lake. So I don't want to get too smart and try to sell short a stock that's already very cheap. I would much rather concentrate my shorting attention on something like Deere that we looked before, that's selling for $100. Not comfortable shorting the stock at $5.
Natural gas, yes.
NGF7? F7. All right. Well, talking about falling daggers, first thing I would do is draw a channel. The channel that comes to mind first is from this high, from there to here. Can we see some more history on this chart and just see where we've been? All I know is we're in a solid downtrend. I see nothing that interests me. Obviously, this kind of angle of decline is not going to continue indefinitely. We're going to get another knee-jerk reaction. But there's nothing here that on the weekly chart that speaks to me in terms of being interested in going counter trend. Let's see the daily. Yeah, it's the same story. Here too, we're grossly overdone. You look how many down days we've had since this high. I would say probably, as a guess, say it's 18 days, we probably had 15 of them close lower. But there's nothing here that talks to me at all. I'd just be watching and waiting. It's in free fall. This is March. This is better, right? Yeah. Can we see some daily volume on this? Okay, well, did we make a new low today? Well, we tested this low and held. I would say on a near-term basis that the market seems to be trying to stabilize. We've broken the downward stride, the immediate downtrend line. I don't think I would be very interested in this stock, in this futures contract right now, but I can see that it looks to me like it wants to try to at least work in this trading range right here. I can see that much. That's all I have to say about it.
Well, let's take a look at the weekly chart then. Natural gas at some kind of support level, slightly above $6. It's a very difficult contract to trade because the contract is very large. It's a very expensive market, and the volume is very low. So difficult market to trade. But if we blow it up a little, I'm generally a bull on energy. I'm convinced that Hubbard's peak is a valid concept. We'll talk about it more tomorrow. But basically that the world is entering into an energy shortage situation. We're not going to run out of energy, but the era of plentiful energy is over. And so we can expect pressure on the energy prices. Plus there is a wild card that all kinds of geopolitical events can can really goose up energy prices, while no great discoveries are in the cards. Basically, all the great discoveries have already been made, according to Hubbard's peak theory. This market is sitting at support. There is a bullish divergence of a MACD histogram on the weekly chart. So in terms of the system, we're actually getting a buy signal. If we go to the daily chart, please. On the daily chart, we're actually in a very curious area. Back in December, natural gas came down, and look at the low in a MACD histogram. It came up just in the last couple of weeks. A MACD histogram crossed to the positive side. I call this breaking the back of the bear. And now prices are sinking, and a MACD histogram is declining. What very well might happen is that if prices continue drifting even slightly lower for the next few days, we may get a marginal new low on the on price, while a MACD histogram goes below zero and holds there. And when it ticks up, there will be a beautiful bullish divergence. So we'll have a bullish divergence on the weeklies and bullish divergence on the dailies. A buy signal, a buy signal is coming together. We don't have it today, but a buy signal is coming together. And what I do in my work, my weekend homework, I analyze crude oil, heating oil, natural gas, and unleaded gasoline. So now that I'm awake and alert and paying attention to this emerging serious bottom in natural gas, I will want to apply the same kind of analysis on the weekend to other energy markets and see maybe I will get an easier, better trade in crude oil or heating oil. But it does look like a bottom is starting to shape up. David?
If we were to make a new low, I would be more interested in this situation. To see it test and make a new, here we've tested exactly this low if you told me the numbers right. In any event, if we should have another dip under here and very little downward follow through, and if you would go back to the weekly here one more moment. There are some lines here besides the one I showed you. Look at this reverse trend line from here across here, coming down. All right, and then draw the downtrend line that we had originally. So you got this nice falling wedge. And then last but not least, from an Elliott wave point of view, which I can't help seeing, A, B, 1, 2, 3, 4, 5, C, a beautiful ABC correction or formation. So we could indeed be at a very important extremity. We just need to see a little more indication, a little more action. So let's go to something else.
Yeah, let's go to
PG.
All right, there's something we've all heard of.
PG. That dog has been around for a while.
Yes, he has.
To me, the power of technical analysis is in being able to analyze the past, detect certain order in behavior, and then very cautiously extrapolate it into the future. So that's why when somebody shows me a chart that doesn't even fill the whole screen, I say there's not enough history. My edge is being taken away from me. I'm not playing this game.
All right, Alex, you.
It's a scary chart. It puts me on edge. Certainly, in terms of its own history, it's expensive. Looking at a 12-year chart, it went from below $20 to above $60. It had an extremely unpleasant experience in '99. Generally, very low volatility stock, but when it goes down, somehow, look how it went down. It goes down in a very sharp way. Let's start opening it up a little. We had a breakout, and the stock actually is accelerating to the upside. It's accelerating to the upside, green, which means we're only allowed to buy. At the same time, I'm looking at the indicators. MACD lines look pretty awful. Force index is slowly degrading. The chart only allows me to buy. It's so far away from value that I wouldn't buy here. The last opportunity to buy was a week ago. Let's take a look at the daily chart. It only allows me to buy. As I said, it's green, buying is permitted, shorting is prohibited, but it's trading in an area where I said I would never buy, and that's at the upper envelope, the upper channel line. So it's a bullish stock. It seems to be going contrary to the market. The only way my system allows to trade it is from the long side, both on the weekly and on the daily chart. And so if someone said to me, if you said, for example, that you have this employee purchase plan, for example, that you have to buy PG, then I would say, well, let's go back to the weekly chart for a moment and find out where the moving average is at the right edge. It's at 63.76, and I would say, well, if you really have to buy this stock, then the buy order would go in the $64 area. Don't pay $65.54 for it. Put your buy order a little lower.
All right, let's go to that bigger chart you had up here. First thing I wonder is just drawing a channel starting from this low over to the low, I guess, in July of 06. And then put a parallel across this high right here. Alex drew the horizontal line. This is the channel we're in. There's still room to go up, I suppose. Can we go to a daily now with volume? Well, if this low is correct, this is the biggest or the greatest amount of selling from intraday that we've seen since the June low. You know, the trend is up. I don't see anything that's bearish. I see that we're getting near the top of the, we still have room to go on the up channel. The market is extremely strong. There's nothing here that's indicative of climactic action. It's not something I want to jump aboard, but the trend is still up. There's no real danger sign here. Next.
ADM.
Yeah, Archer Daniel Midlands. Archer Daniel Midlands is the biggest processor of commodities in the United States. It had a massive bull market, essentially went vertical earlier last year. You can see how it accelerated to the upside. Let's open up a little bit. Went vertical, hit its head on the ceiling, started falling. There's a steady downtrend in this stock. The ranges are becoming tighter. Look at the amount of participation in the stock near the top. Look how much tighter it's getting on the way down. No divergence in MACD histogram, a little bullish divergence in force index. So I would say with the stock being seriously below value, decelerating to the downside, if I had to trade ADM, not my type of stock to trade, but if I had to trade ADM, I would be looking for a buying opportunity. The blue bars certainly allow me to buy. Let's take a look at the daily chart. It's really nice how it divergences, of course, but it's also nice how it kind of cracks a little bit down and pulls back, and a little bit down and pulls back, a little bit down. I don't see any great ease on the way down. It very slowly and grudgingly goes slightly lower and bounces up. Meanwhile, everybody sees bullish divergences across the board. I think it's a stock that's groping for a bottom. Although at the right edge of the chart, the rightmost bar is red, meaning that we're allowed to sell, not allowed to buy. That's certainly a bearish configuration. So, but to me, it's a stock that's groping for a bottom.
All right, can we look at a daily with volume? Can you tighten it up first? Okay. What's the first thing that I would see on this chart in terms of the near term? Spring position. Of course, there have been lots of potential springs. Here was another potential spring right here underneath this line, and it rallied. I like this much slower grinding down move here, and then the lateral movement, and a few days ago, the market goes underneath this line, reverses nicely, gets hit naturally, but until today, we had 2 days with the market trying to go down and holding back near the upper end of the day. If this stock should jump back above the high of yesterday, or even today, I think it might be worth a play on the long side, at least for a short-term swing, maybe back up towards this line. But right here and now, there might be something if we can reverse back above these three little highs on a short-term basis.
Well, David, thank you very much for coming here from Boston.
Alex, we've had a great time. This has been a wonderful workshop. I know we've been several other places, but this ranks right near the top. I've met a lot of very interesting people. I think some of the ideas about Wyckoff and price volume behavior that I've shown on this camp, they've even become more apparent to me. It sort of brought it to life to me again, certain aspects of it. This is just one facet of the material, but I wanted to really stress the importance of the springs and how one can make a living trading springs. I am available at any time for those of you who've listened to this tape and viewed it to give me a call or send me an email. I'd love to hear from you.
Good. Thank you very much again for having come here to teach. I know that you like to spend most of your days in front of the screen, alone, isolated really in your trading office. And it took a lot of energy on my part to tow you out of your office and to bring you to the camp. And I'm so glad that you enjoyed coming here and did have a good time. And people sometimes ask me, well, what's the point of teaching if you know how to do this thing? And what you've just said reminds me of what I've said to people many times. Preaching is good for the preacher. The kinds of questions that we get from the group often invite us to think deeper, to explore the concepts. It was a great experience sitting in your class. I enjoyed working with you yet once again. And somehow I have a suspicion that this is not the last camp we run. There might be another camp in the future. I look forward to you coming here again. Okay. Thank you, David.
A lot of fun.
Thank you very much for having viewed this video. Enjoy it, study it, review the points that appear especially important to you. David invites you to get in touch with him. You're certainly welcome to get in touch with elder.com. We wish you well. We wish you success. Thank you for coming. Good trading. Suffering. Hopefully something good will come out of it, just as the previous important week-long endeavor. Welcome to our graduation dinner. I'm glad everybody made it through the week. And I want to use this opportunity to thank all of you for coming, and especially to thank David. And today we want to give him a special award for his teaching excellence. And David will be accompanied by his teaching assistant, Karen. David, thank you very much for coming here. And we decided that you were a little too formally dressed for this camp. Yeah. Thank you very much for being here. And we're going to dress you in the proper tropical fashion. Ah. Right. You, David. We're gonna make a samurai out of you. Every samurai deserves a geisha. And David, we got you a geisha. Karen, come on up, please.
This is what they call